All right, hi. Thanks so much for watching today. In this video, we're going to compare whole life using a term dividend option, or sometimes these are referred to as a economy option on par products. I really like this concept for maybe comparing a UL or someone who is looking at permanent insurance, can't maybe afford the full paid up additions, but we want something with a little bit of cash value in it. Again, if you're not familiar with life design analysis, sign up for our 30-day free trial. I'm going to create a case here, and again, I'm just going to start with my sample case here. Or again, I can start with Charlie Robb here. This is a 50-year-old male non-smoker. I'm going to focus on $1 million of insurance benefit. But this concept really works at any different insurance benefit. And again, I'm going to show this two different ways. So the first example, I'm going to show someone who maybe is looking for permanent insurance. So I'm going to search for a T100 minimum funded UL. And again, I'm just searching out of these LifeGuide rates here that are integrated with our software. If you have LifeGuide, you get a 50% discount to our services. So do check it out if you use LifeGuide currently. Again, I can select anyone from the case. So again, whoever your preferred carrier is here. I'm going to go with BMO here. It's right near the top of the list. And again, I want to contrast this and say, look, here's the minimum amount you could put in insurance. But maybe I know my client has some room for a little bit more deposit or wants to take advantage of some of the tax advantage cash growth inside of a policy, but maybe can't afford full paid up additions. What I'm going to do is I'm going to show them another option here. So I'm actually going to add a Manulife whole life plan here, because again, these economy options usually are whole life, but they've got basically a YRT built into them. In most cases, and what ends up happening is that the YRT is slowly replaced by kind of the paid up addition, but it is a little bit of a balance. So again, we want to draw up our quote really carefully. I've gone ahead here and drawn up a quote for a 50-year-old male. You can see in the performance credit option, again, because Manulife not a traditional par policy, they use a performance credit. All I have to do is select term option here. And again, it's called different things inside different manufacturers. I know Canada Life one has one, the Eco option, Equitable Life, I'm not sure, I think they have one as well, and Empire definitely has one on their Estate Max. But anyway, check with your wholesaler to see. Lots of companies offer them. Again, they allow you basically a maximum guarantee for 10 years or a lifetime guarantee, so you can play with that, and that's kind of changing the balance of that YRT. But again, you can see the premium, again, this is $1 million versus, say, the paid up edition here. And just to go back here and just kind of show you paid up edition, it's about half as expensive. So again, this is something for someone maybe with a tighter, maybe premium deposits are a little bit more of a concern. Again, I'm just going to set this one up for 20 years. It's kind of the nice thing, again, because it is a par policy or a whole life that you can use an offset. And that's really going to be my advantage. And again, I've just kind of, I've reduced mine a little bit here just to be a little bit safe. I want to be conservative with these. Anything with a YRT, again, is dealing with a little bit of risk. So, I want to show that, for the first 15 years, it's going to be reduced by about 2%. And following that, it's going to go back to sort of its current performance rate, or a little bit higher than it is right now. And actually, I might change that just because it's 6 right now. So I'm going to update that. Basically, same process again. Once we create the quote exactly as we want it, the big change being that we're choosing that term option here. That's the big change in the quote. Again, I'm going to view the data and send that to an Excel sheet, just as we normally would with whole life. And again, I'm finished with the quote. All I really want is this information from the spreadsheet. And again, I could either save this as a CSV. I'm just doing the Control-C, or I'm copying the information after I select it all. And I'm going to use the paste method here. And basically, once I paste in the information there, I can upload it. And again, don't worry that it's jumbled. We're expecting all that kind of information. Again, I just want to explain what I've done here a little bit. So I click Edit. I'm going to say this is Manulife PMAX Gold. And under the description, this is where I'm going to say this is a 20-year payment schedule. I should say planned. And it's not participating whole life, but I want to say this is a term dividend option. I'm also going to say 4.5% going to 6 year 15. Again, anything we can just really do to help describe it to our clients. So once I enter that information, I'm going to save it here. And again, just within our controls here, I just want to show, I'm going to push out to age 99 there. I want to show over their whole life. But essentially, once I got my product loaded, I just hit generate report. And this, again, I find is a great sales concept for someone with, maybe they even have a current UL and they've come into some money and they want a little bit more cash value. They want some options with it. But, here's really why I like this one. Okay, so the basic minimum funded UL with no cash values is 13 grand. Over here on the right, it is a little bit of an upsell. So again, there are some advantages to that from an FYC standpoint. Again, it's 16,000, but it's really not that much per year more. Again, drops by even $100 in the 15th year, as Manulife plans normally do. So at $3 grand extra a year, it's really not that much more of an ask for a lot of clients. And again, the nice thing is that because I've designed this one with an offset of 20 years here, we're going to see some significant savings when we actually sum up the premium. Because again, we're not accumulating premium after this age 70, and again, it helps with that sort of the income as well. So again, we're going to see a significant savings here. And the other thing I like about it is, again, because of that extra deposit room, we also show a nice healthy cash value. And the one thing I think clients really appreciate, definitely like early cash value, some of them, but when we look at our total premium accumulation versus say a cash value, again, it's fantastic that we do have a return of premium greater than what we would have paid. So again, if everything goes according to plan and we get for that 4% for the first 15 years, and maybe there's going to be some, even 4 years at the current dividend will get us to this point here. Again, if we cash out at age 70, don't need it anymore, we can leverage it. There's lots of different things we can do with it. But I think it gives our clients some options and, again, provides a little bit more value, especially considering that we're saving a little bit of money long term if everything goes to plan. And that, and again, we've done this one pretty conservatively, I think. But again, there is still a little bit more risk. And again, there are still things built into this contract, such as guarantees. And again, if it reduces, I set my reduced value at 4%. So if it does stay 4 the entire time, again, you can see that the cash value is going to collapse there. It is past life expectancy, but again, that's that risk performance. We've got to make sure with something with a YRT in it, that we're disclosing that to our client. But again, an easy way to show them kind of, two, I think, very progressive insurance assumptions, but again, it's important. And one of the different things again about one of these plans is that you'll notice that the face value doesn't really take off until age 92. So it's not really about that paid up additional insurance. It's more about the kind of the icing on the cake that there could be some cash value, and really though that it fits the budget. So it's a great upsell, I think, on say a traditional whole life sale where you need to jump to those huge premiums of the paid up additions. So going back here again, it is a good kind of exercise to say, even though we do have this basic minimum funded for life, another great comparison or sales idea could be the fact that we could take this term dividend option here, PMAX Gold, and actually compare it to say the full option. Again, sometimes when clients are given two different choices, again, they know they need insurance, so it's just what fits the bill better. Sometimes they like seeing how much extra that performs. So equally good comparison is if I come back here to my Manulife software, and again, I'm just going to come back, I'll get rid of this old quote here, and I'm just going to change this to full paid up additional insurance and update that. So again, a lot higher price. We're going to export it to Excel, produce the spreadsheet of our quote here. I just want to make sure, 20 years, perfect. Again, here I want to just show, select everything and copy it, come back to our software, and I'm using the paste method here. Paste it in there, and again, of course, if I was showing this to a client, I would, change this whole life to say PMAX Gold and explain exactly what I did. Same assumption as far as dividends go here, but again, we've added the full paid up additions, and I just really want to highlight here again, even this is a good compare where, you might show the full blown paid up additions, and that's the ideal sale, but you can also show what the extra deposit room does and how that impacts the IRR. So again, it's double the deposit, so it's essentially double the premium. We're going to see a lot higher kick, even visually, of these two cash values. Again, important thing at 20 years is that we have more cash than we paid for the policy. People like to see that. Again, insurance benefit's going to be different because of the different deposit. You can overlay these and look at how the cash compares. Really, though, when we are looking at different deposit, different returns, I think a lot of it comes down to the internal rate of return for a lot of clients. And again, you can see the whole life with the paid up editions still has a stronger IRR of cash value. So, you can justify at the end of the day, I still think this is a good compare because it's actually performing stronger. Even though you have invested more, the return was greater. So you're working with those efficiencies. And again, if we look at it, the term dividend, which I named the PMAX Gold here, is actually stronger short term. Again, because of that lower deposit. Again, long term, if we look out to life expectancy, they're both pretty good, but the full paid up editions are slightly stronger here. So again, good options for your clients where you can still make kind of a nice sale, something that's right for your clients and gives them a little bit more value for that dollar. Again, if you want to turn this into a PDF and brand it, again, simply produce it like that. Anyway, that's our video for today. If you have any questions, email me at charlie@lifedesignanalysis.com. But thank you so much for watching.